Carvana is Yahoo Finance's worst company of the year. The online used car dealer stock looking to finish 2022 in bad shape, despite a strong start to the year. Weak third quarter results, as well as liquidity and financing concerns, have been weighing on the stock. And here to talk about this more is RBC Capital Markets Internet analyst Brad Erickson. Brad, thank you so much for being here. It seems like at this point, the most immediate, urgent question looming over Carvana is whether it has enough cash to keep going. So I'm just curious where you weigh in on that issue.
Yeah, thanks for being here. Nice to see you guys. So they've got, first of all, I mean, it's just, if we want to go through the numbers, they've got $4 billion technically of liquidity. The issue is a couple billion, more than a couple billion of it is in real estate and sort of tangible goods that technically are financeable. The problem is these guys have some fairly onerous covenants under their debt agreements, particularly the floor plan facility, right? The piece of debt that allows them to keep cars on the virtual lot, so to speak, where now they have to keep 20% of cash on the balance sheet to sort of cover that in the event of further demise. And so that's really the problem is there is a liquidity risk that is building here. They could, they have several quarters of cash technically, but of course, when you've got debt on the balance sheet to the tune of $8.5 billion against an equity value here just below $1 billion, you see things like the cooperative agreements between seven large creditors forming last week, preparing for what appears to be something more dire here coming up.
Brad, I think a lot of folks would acknowledge this is an intriguing business trying to disrupt the status quo. Do you see some form of, strategic acquire here at some point, just given how far the stock has fallen, how far the valuation has fallen, and considering they do have something perhaps intriguing on their hands?
Yeah, I mean, I think you saw someone like an Apollo Group come in, I think probably with some of that thesis in mind. The issue is simply that the execution on how they're going to get the cash generation to support the debt load on this business, that has the potential here to be a very, very messy restructuring process. And I don't know that, to your point, like online car retailing is clearly a secular growth driver for the much longer term. However, this company has gotten itself into a situation where it way over acquired capacity earlier this year when it bought ADESA, which is the second largest used car wholesale company in the U.S., and piled on this $8.5 billion of debt, $650 million of annualized interest expense, and burning $400 million of cash per quarter. So you can see, you put that all together. Clearly, they have to make some changes. And then the sort of double whammy punch that happened was that the used car market is down 30% year over year right now. And so you're effectively going to have to compress the business just to start to be able to give investors confidence that you can generate some cash to start to support that debt service here coming up. I don't know that that's particularly attractive from an acquisition standpoint. I think it probably makes more sense to let the existing players, be it the founders or the largest shareholder, which is the founder's father, and or the debt holders, to come together and try and form some type of restructured financing to be able to move forward.
Brad, from your estimation, what kind of rebound in the used car market would Carvana need to see and other players in that market in order for them to avoid any kind of catastrophic moment or even just to warrant a recovery?
Yeah, so historically, when Carvana had started to decelerate, for its first 5-6 years in the public markets, Carvana was growing 100% in many cases, and then growth started to come back to earth as the numbers got bigger. For the last few years, Carvana has been able to generally outgrow the market by about 20 or 30 percentage points. Well, if you're down 30%, the math is pretty simple. They're probably more in the down sort of 10 or maybe even like 15% year over year. The market were to recover by, say, 15, 20, 30 percentage points, they'd go back to growing 20%. That's probably the minimum that they need to really start to improve the business. as I said earlier, though, the problem is when you're burning hundreds of millions of dollars of cash, they are actively downsizing to be able to get to unit economics profitable, and they need some help on the unit side, frankly. And then you're into the interest rate conversation and how are used car sales going to improve? And it's tough from my perspective. We don't have a lot of visibility on why that would happen here in the near or even medium term.
RBC Capital Markets Internet Analyst Brad Erickson, thanks so much for joining us. Appreciate it.
Thanks, guys.